great to see you. One of the things that stands out in my notes is that, thinking back to Gordon Gekko, who said greed is good, you basically say fear is good, and we're in a period of fear, and that may tee up a better market early in 22. Explain.
Well, I think that actually the outperformance of the S&P 500, Tyler, maybe going back all the way to since the financial crisis, I think has been based on fear. You know, when people are fearful, they're going to still invest in the stock market, perhaps, but what are they going to do? They're going to go into the largest blue chip, most well-financed companies, and those that have an independent growth source not related to the economy, if they're concerned about that. And that's large cap growth. That's new era. That's tech that's been dominating everything else. As we head into 2022, the relative PE, relative valuation of everything but S&P 500 is cheap, whether it's small cap stocks, mid caps, cyclicals, international markets, everything but the S&P 5. And the key to getting people, other parts of the market to outperform, I believe, is lifting confidence finally. And I think we have a shot at that sometime next year. I think the two biggest fears we've had, Tyler, of late is COVID and inflation. And I don't know what's going to happen, but I suspect as we move through 2022, we're going to move COVID in our heads from a pandemic to an epidemic and move on. And I think inflation will moderate, even if it doesn't return to 2%. If it just starts to moderate, that'll eliminate a lot of intense fear of runaway inflation. And if we lift confidence, I think that's going to run through the market in a big leadership shift away from large cap growth stocks, more to the broader market plays that I highlighted. We just haven't had in this entire COVID crisis a period of confidence, really.
More than that, Jim, you're even highlighting in your newsletter that if you go back and look to 1950, that these periods of massive increases for inflation, for CPI, have been followed by relatively good stock market performance. Lay it out for us. I mean, I'm looking at the 70s here, and I'm thinking, oh, we think we have it bad now. It is true. In the 70s, they walked uphill both ways.
That's right. I mean, when you go back, I can't remember the exact number, Contessa, but there's something like 14. This would be the 14th major spike in inflation since 1950, if we're peaked out at around 7% here. And 10 of the previous 13 was 1 year after it peaked, resulted in very good S&P 500 gains. The average for all 13 is something in the ballpark like 13%, but the average for the 10 was closer to 20% returns after inflation peaks. And, you know, you don't have to, you can say inflation can stay elevated, but if you just think it's close to a peak, that's traditionally been a really good time for the stock market in the coming 12 months after that. You can kind of see why people are fearful of inflation running away, and when they find out it's not going to do that, it's a relief.
Shepard Smith here. Thanks for watching CNBC on YouTube.